Welcome to the Q4 2024 earnings call for Dolla Financial Services Limited. It is our pleasure, as always, here at Learn Grow Invest to moderate this call and to have the Dolla team with us. So, as we are preparing to go into the call, let us open with a word of prayer. Heavenly Father, we give you all glory, honor, and praise, Lord. We thank you for this day. We thank you for this platform, and we thank you for this opportunity to come together with Dolla Financial, Lord, to share about their business, Lord. We thank you for a successful quarter. We thank you, Lord, that they're able to connect with their shareholders in this way. So we just give this call over to you, Lord. May you have your way. In Jesus' name we pray. Amen. So with that, I would love to welcome Kenroy Kerr, CEO of Dolla Financial Services, who will be hosting and chairing this call along with his team. Trevine and David will be here as well, but I will hand over to you, Kenroy, so you can get right into it.
All right. Thank you. Thank you very much, Renee. As usual, it's really a pleasure to be here. Thank you once more for facilitating our earnings call on your Learn Grow Invest platform. It's a pleasant morning to the viewers, to our shareholders and stakeholders, and everyone who decided to join us this morning. Today I am excited to share with you just some of our milestones, some of our achievements, and our strategic initiatives from 2024, as well as the outlook for the company and the group for 2025. Our call today, on our call today, we have our group CFO, Trevine McKenzie, who will provide you with a summary of our financial performance for Q4 in particular, and for the 12 months ended December 2024, and also give some insight into what's really driving some of those numbers that we'll be discussing. We also have David Henriquez, who is the CEO of Ultra, and he, of course, will share some updates on that business segment. All right, so our 2024 results showed solid growth and improvement in most of our key performance indicators. Throughout the year, we really maintained our dedication to providing our customers with excellent loan services and just earning their confidence and building those strategic relationships. And before getting to the number, I just really want to take a moment to thank our dedicated team. They've been very supportive in terms of the commitment of the company and providing that innovative, easy, and flexible credit to our customers, and of course paired with superior customer service that exceeds their expectations. So the numbers, as I said, during 2024, for the year ended 2024, we saw growth in most of our key performance indicators. In some areas, the growth would have been more robust than in other, but of course we'll just go through the numbers so you can have a better appreciation as to how this company performed as a whole. Here are some quick highlights. I won't go too deep because Trevine, of course, is on this call and will give you further insight into some of these numbers. So our loan portfolio, as of December 2024, stood at $4 billion. I believe that this is a significant number. It represents a 63% increase relative to where we were for year ended 2023. You can actually see the gradual improvement in the loan portfolio coming from about 2.6 billion in 2023 to 4 billion as at the end of 2024. Our profit before tax was at $482 million. This represents about an 9% increase year over year. This is one of the areas where the growth would not have been as robust as I know investors would have been looking for and what the management team would have expected for 2024. However, and it's not aligned with the growth in the loan portfolio being about 63%. But further on, you'll see that the growth in the portfolio, the bulk of that growth actually came in the last quarter of 2024. So we'll be realizing some of those benefits during 2025, of course, in Q1 and onward. Our NPL was stable, I'd say, at 9.9%. And this is still relatively low given the nature of the business that we do. And of course, when we compare it to other players in the industry. The ECL stood at 2.6%, and this is like a record low for the company. Of course, you'll see where our secured loan strategy has proven quite instrumental in maintaining the loan portfolio quality, with the NPL at 9.9% and the ECL at 2.6%. Of course, the expected credit loss is a metric that you use to kind of assess the quality of the loan portfolio, what percentage of your portfolio is really exposed to a write-off or a loss once you book a loan. So it's really good that we have been able to maintain, I believe, one of the lowest ECL in the industry. And of course, our efficiency ratio ended the year at 49%. And of course, this is a great indicator that we've been very prudent in terms of how we manage our expenses as a company. Of course, for years, I believe over the last 3-4 years, we've not exceeded 50% in our efficiency ratio, which is really good for the company. Now, beyond the dollars, we really continue to demonstrate our commitment to our corporate social responsibility. And we did engage in a series of impactful initiatives during 2024, particularly in the last quarter. We would have contributed about $250,000 to the during Breast Cancer Awareness Month to the Jamaica Cancer Society, just to assist with mammograms for, I believe, about 30 ladies to complete that procedure. And we're really happy for that partnership, and we'll continue to find ways that we can impact persons on a daily, weekly, quarterly basis. We also had our Gift of Hope, where we selected about 12 homes during the festive season, and the team from all of the branches participated, just brought joy and gifts to those less fortunate in those homes. So we're really proud to be a part of that initiative as well. In terms of strategic initiatives, of course, during Q2, we'd have opened our 11th branch in the beautiful parish, I'd say, of St. Thomas. And I can report that branch has really been performing well over the last 6 months, much better than even what we had anticipated. So that's a really good strategic move during 2024. We also launched our One and Ready 2.0, which is really an upgrade of one of our loan products, and we saw like tremendous traction with that product during the second half of 2024. I believe we also exceeded our expectation when it comes to the number of applications and the value of loans that we got from this program. It was one that pretty much assisted taxi operators to own their own vehicles with an opportunity to actually win a vehicle at the end of the campaign period, which was December 31st. And we have already selected a winner with a handover planned for the 28th of this month. So we'll also share some highlights from that in a few weeks. All right, and of course, we continue to just assess the need of the market, look at the seasons, and ensure that we are engaging with our customers and just finding innovative ways to meet the need of the customer as the seasons go by. And of course, in Christmas, we would have had our payment holiday promotion, where all loans that were disbursed from October, November, December, the customers would have enjoyed a payment holiday, meaning if you applied for a loan in November, your first payment would not be until the end of January. Of course, ensuring that the customer can do and really enjoy the season during December. All right, so I'll just go quickly into just give a quick review of the loan portfolio. Just this really represents one of our largest asset. I believe the loan portfolio is about 90% of our total asset, and of course, quality and what makes up this asset is very important. So we're just highlighting some of the different metrics that we use to measure the loan portfolio and the quality of it. As you can see in this graph, the loan portfolio remains, our secured loan strategy remains very important. We are now at about 87%, 89%, sorry, of the loans that we have disbursed are secured. Let me just ensure that I'm correct here. 86%. So 86% of our loans outstanding were secured, while the remaining 14% would have represented unsecured loans. And similarly, we had about 87% of the loans being disbursed to being or going to small businesses, medium-sized businesses, and also entrepreneurs, while the remaining 13% of the loan portfolio actually represents loans to personal consumers. As you can see in this graph, the loan portfolio remains well diversified across multiple industries, which really reinforces our commitment to supporting a broad spectrum of economic sectors. And this diversification remains a key component of our strategy to ensure that we are not too exposed to any given industry, and that we are focusing on where opportunities exist in different sectors while fostering economic growth really across all of the various segments. All right, and I've gone through these numbers earlier. So again, our secured loans were 86% of the portfolio, which is above what we have as a target internally. So we'll continue to just push that strategy, which is what would have resulted in us having a really, really low expected credit loss of 2.6%, as well as a non-performing loan of 9.9%. Overall, the non-performing loan, I believe, is a little bit up from 2023. At the end of 2023, NPL stood at about 9%. So this is a slight increase. However, I just want to point out that sometimes fluctuations do happen. It doesn't mean that there's 9.9% of the loan portfolio that we are unable to collect on. It just means that we may be in the process of liquidating assets for a particular loan, which is taking more than 90 days, a real estate secured loan, for example. And as at the end of the year, once these accounts are over 90 days in arrears, then it will make up a part of the number. However, in Q1, we're working on those accounts just the same to get them out of a non-performing state. And because the portfolio is so heavily secured, then you find that these accounts tend to, even when they go into a non-performing state, there are strategies in place to get them out of a non-performing, out of the non-performing category. All right, so at this time, I'm going to pause and I'll hand over to David, from the CEO of Ultra, who will just give you some insight on that segment.
Hi, morning, guys. Thanks, Kenroy, and thanks again to the Learn, Grow, Invest team for having us. Ultra is always happy to be here. So I'll jump straight into it. So in 2024, once you follow us pretty closely, you would have noticed that we rebranded to private credit. And the reason behind this is that Ultra has always prided itself on being very transparent to the public, the shareholders. And so we wanted to make it very clear to you exactly what we were doing. When we first began, we were in the segment of, kind of luxury lending. And it's not that we've changed much, but it was basically bringing an awareness to the public of what we are capable of doing. And we are still capable of doing everything that we did when we first launched. But we have just transitioned into private credit, because that's the line that we really want to take on, and the service that we really do want to provide for the Jamaican public. So during 2024, our loan book grew to 1.55 billion as at the end of 2024. And as you know, we are 100% secured, and we do hold collateral in a loan to value ratio of about 50%, meaning that if your collateral is valued at 15 million, we'll lend you half of that 7.5. So collateral held is just approximately $3 billion. So I know Traveen will go through the financials and go through numbers, but at Ultra, we had said in our last earnings call that our aim was to get to 2 billion, etc. And we didn't meet our budget, and but we are still very proud of the growth that we've made. I mean, profit before tax was up 54% year on year. Our loan book increased by 57%. And so, we definitely did have positives throughout the year, and we are proud of our performance. But, we don't accept mediocrity. So we are definitely pushing to do even better this year. Our team has grown, so we're now up to about 8. We have 2 members to add in the coming months. And, we're going to keep our team pretty small but dynamic, and definitely keep the vibe that we have going at Ultra as we continue to improve and meet the targets that we have promised you and promised the public on a whole. So as we head into 2025, the aim is to obviously get our loan book to 2 billion by the end. As much as I say the end of the year, we'd really like to push to have it done before the summer. And then obviously keeping our NPL under 5%. I know Kenroy just mentioned NPL and explained a bit of it to you, but as you know, that with the size of Ultra loans, the NPL can fluctuate, with Ultra just based on the size of the loans. So we will always want to keep, a very, very tight rein on that. But, it does take time to liquidate assets, especially some assets that are worth a lot more. It does take some time. So we definitely will always keep an eye on that, and obviously keep you guys abreast as to what's going on. Our process can never be perfect, but we want to continue to strive for perfection. So, we do aim this year to improve on our processes and just continue to strengthen our loan book and strengthen the diversity of our loan book as we get into different industries and support the industries that need us, not just, the construction and real estate industries, but really getting there to, the transportation industry, tourism industry, agricultural, etc. So we just want to continue to diversify our portfolio and keep growing. And as I mentioned, we really just want to keep our team dynamic and strong as we continue to take Ultra to the next level. And so at that point, I'd like to introduce Trev. I don't have to say anything more. So Trev is here to give you guys the numbers.
Thank you very much, David, and good morning again to our viewers. So let's jump into the numbers. Kenroy did mention some of our major financial highlights, so we won't spend much time on this slide, but as you know, the company would have grown in terms of income just about 24%. Our loan portfolio grew by 63% to $4 billion, which we are quite proud of. Our expenses also grew by, to a lesser extent, 24% to $707 million. And of course, our profit before tax grew to $482 million by 8%. Not what we were hoping for, but we are still very happy that we were able to achieve year-on-year growth during 2024, especially given the shutdown of Guyana and all those things that took place and the delayed fundraise that took place last year. But let's jump into it. So we did mention year-to-date profits of $482 million. It's just a slight increase year over year, and then we'll talk about how we got here. We'll talk about income in the later slides, expenses, and how all of that contributed to the bottom line. Kenroy also did mention our ECL, which stood at 2.6%, which is our absolute lowest we have seen. And of course, this is due to the secured portion of the loan portfolio. NPL did increase to 9.9%. I believe this was up a couple metrics, but of course, we are still below the industry average. We did have a couple of loans that are in an arrears state, and luckily for us, these loans are secured, so we're working on curing. on curing this by, of course, offloading the collateral, which does take 3 to 6 months in some instances. So 3 to 6 to 9 months in some instances. So we're working on this, and we should see where it will be reducing to our normal 8.5% in short order. And of course, our efficiency ratio at 49%. This has been holding firm, really, because we haven't been fluctuating above 50% over the past few quarters. So we're very proud that even though we did not achieve the year-to-date profits we were hoping to, we're still running a very efficient business, which is key. So I believe that summarizes what happened in terms of the big numbers and the big metrics. Now, looking at the balance sheet in detail, our cash and cash equivalents stood at $355 million as at the end of December 2024, which represents a 9% increase year over year. We have been speaking about finishing each quarter and each year with a stronger cash balance, and we are proud to have done that this year again, just to ensure that we have enough cash to sustain us in the following quarters. So this is something that we had achieved and we're proud of. Also notable was the loan portfolio, which stood at $4 billion, which is a 63% increase year over year. We had seen where the loan portfolio had been creeping up over the past few quarters, and in the final quarter, of course, you would have seen where we published that we closed our $1.65 billion bond with Mayberry. So because of that, we would have experienced a 75% increase in disbursements when we look at September of 2024 and December of 2024. So this surge in the loan portfolio of 63% really came in the final quarter. And we'll then now take a look in the later slides about how this transcended into interest income. On the balance sheet, just lastly here, loans payable, of course, increased by 73%, up to $3.2 billion. And there's no surprise here. We would have raised that $1.65 billion bond that closed in the latter part of Q4. And this is solely what led to the increase in loans payable. And of course, we're seeing where all of this would have transcended into the loan portfolio. And we will take a look at how this affected our profits in a good way. So if we take a look now at the interest income, firstly, we're going to take a look at what's transcended year over year. And then we're going to take a look at what happened quarter over quarter, just so we can really see the growth when we look at Q3 and Q4. And year over year. So in terms of between December 2024 as from a year-to-date perspective and December 2023, we did experience good growth in total income of 31%. Income moved from $1.1 billion to $1.5 billion. And this is, of course, due to the funds that we would have unlent in Q4 of 2024. As I mentioned before, we did see an increase in disbursements, just about 75%. In Q3 of 2024, we would have unlent $400 million in terms of new loans. But in Q4, we would have seen where we unlent over $1 billion. And of course, this is due to the bond raise that took place as at the end of that quarter. And I must say that this is the most we have ever lent in the history of Dolla. So we're quite proud of the work that the sales team has done. And we're seeing where all of this really transcended nicely into total income, which really took us to where we needed to be as at the end of Q4 2024. Outside of that, we did see increases in operating expenses by 38%, moving from $549 million to $757 million. Now, notably, what happened here, staff costs, of course, which is our biggest line item on the income statement, increased by $65 million year over year. Just about 21%. And if you have been following, you would understand that we would have done a benchmarking exercise, which is a 3-year process to get everyone up to the benchmark based on an exercise that was done by an external party. We also had several initiatives for our staff to ensure that everyone is motivated and ready to work. And we're seeing where this has been effective because we're seeing where the sales has increased. Other things such as legal and professional fees also increased by 45%, up by about 25 to $30 million. And of course, this is due to, firstly, the collections. We have been focusing a lot on collections. We have had increased professional fees due to the bond raises, etc. So all of these things would have led to the increase in operating expense, in addition to audit fees. But we are seeing where it is being cushioned properly by total income. And of course, we spoke about profit before tax. So with the increase in sales, we would have seen the increase in total income, corresponding increase in operating expenses to get us to where we need to be for Q4 of last year. And of course, to assist us, give us a head start into Q5. We're seeing where all of this transcended into the profit before tax. And it's also important to note that we would have made preparations in 2024 to assist us with the demand that we are forecasting for 2025. So going forward, we won't see where operating expense will be increasing by 38%. We'll see a lesser increase because we made preparations in 2024, and we are seeing where it will happen year over year in 2024, but not in the following periods to come. And also, lastly, earnings per share, of course, grew, and we're happy about that. And EBITDA also saw a significant increase of 27%, much greater than profit before tax, up to $822 million. Now, if we look at quarter over quarter, we're also seeing where we did experience growth. When we look at, for example, the total interest income, we are seeing 36% increase, but we are having a flat profit before tax line for quarter over quarter. And that's when we look at December 2024 quarter versus December 2023 quarter, because we did start earlier in December 2023 in terms of disbursements, because the fundraise did come earlier. But in 2024, we noticed that the fundraise did come later in the quarter. Hence, we were not able to maximize fully when we look at the quarter over quarter in this sense. However, it is important to note that when we look at September quarter of 2024, we achieved just about $65 million. And that was one of the only quarters where we fell below $100 million. Once we disbursed that $1 billion in Q4, we noticed that our profits went up to $114 million, which is just about a 75% increase when we look at September versus December. So what this means is that you're seeing where once we get the funds and we disburse, it goes straight into the profit. And we will continue to see that coming into Q1 of 2025, where those funds that would have been disbursed in Q4, we will see the income coming over, just to give us a head start. So the point here is that we get the funds. Once we get the funds, we disburse, and it goes directly into the bottom line, and the growth is there. So that's just us returning to growth, fulfilling our promises. Once we get the funds, we unlend and we move forward. Now, if we take a quick look at our cash position, I did mention that we, as management, we have aspirations of ensuring that we end the period with a strong cash position. And we have done so because cash year over year did increase by 9%, which is small, but the dollar figure itself is comfortable at $355 million. If we look at cash provided by operations, this decreased by 38%. Of course, we would have unlent some funds here and there, and it's just a movement in terms of the operating expenses, in terms of the loans we would have lent out, and the fundraisers in terms of operations. So I don't think this is something a cause for concern, but if we take a look at cash used in investing, we would have seen positive movement in terms of that for 58%. We're seeing where this negative has reduced. And of course, the cash used in financing activities would have increased, but this increase is, of course, due to the dividend payment. And if we take a look at our ratios, no major movements as usual. The notable metrics have remained in line or flat year over year. We spoke about our efficiency at 49%. No major changes, even though it improved. We still find that a 2% is flat. Net interest margin did decrease, and we spoke about that. We spoke about, we did not achieve what we would have hoped to, but we did produce good results for the year. So a 10% movement is also not very substantial here, and everything else is in line. Even though they are in a red, it's still in line, still no major movement. And we're seeing where, if we look at September 2024 and December 2024, we are returning to growth. So we expect these metrics to go back in green in the following quarters. And at this time, I will hand back to our Group CEO, Kenroy Kerr, to just wrap up the segment and take us through.
All right. Thank you very much, Traveen. That was quite detailed. So for this year, just want to quickly touch on a few of the things that we'll be focusing on. Of course, there's always, well, for any company, there's always room for improvement, and that is definitely something that we continuously look at ways of improving our operation. For example, in operational efficiency, while our efficiency ratio has always been at a really good level below 50%, we continue to just look at different innovative ways that we can continue to ensure that we are producing maximum results for our shareholders. We'll continue to look at various aspects of the operation to get the most out of our branch network, to look at where we have tasks that might be too manual or tasks that we're duplicating, to ensure that we bring some automation to the forefront of some of those things. We'll continue to look at our refining our credit model to ensure that the loans that we do disburse are of the highest quality and they do not have any adverse impact on our ECL NPL. For 2025, we are again looking to grow our loan portfolio somewhere to the tune of about 50%. And of course, that will be fueled by loan disbursement. So we'll continue to have discussions about raising additional funds. Of course, that is very important to a growing business. We need the capital to grow. The truth is we'll see some growth once we are able to collect and relend what we have currently. However, the growth will not be as robust. So we'll just continue to work on our partners to find innovative ways to raise funds for the business, for the group. And we'll just continue to focus on efficiency, just growing the loan portfolio and ultimately bringing greater value to our shareholders. During 2025, we'll continue to work with our marketing team to just refine the products that we offer, to look where opportunities exist. I know that there are some concerns in the industry, but in times of distress, there's always opportunity. So we will continue to look at areas that we can improve and look at ways that we can leverage those opportunities to just grow our business and again return the highest value to you, our shareholders. All right. At this time, I believe I'll hand over to Renee, who will take us through the Q&A section. You're on mute, Renee.
Thank you so much. Thank you so much, team. As always, it was great listening. I mean, even after reading the report, it's always good to hear deeper context from you as the ones who are leading the charge, right? So thank you so much for that. We have quite a number of questions in the queue for you. Before we go into the questions that have been posted, I do want to address the efficiency ratio that you would have mentioned, right? 49% is excellent, but I'm asking from the perspective of helping the audience to understand just how impressive that is. Because so let's start with what is the industry average when it comes to efficiency ratio, and how impactful is that for you as a company and for your bottom line?
So in terms of the efficiency ratio, yes, it is very excellent. And we have been speaking about it on earnings calls. We don't find that many companies in the industry, or just companies on a whole, are able to return majority of their income to the bottom line. So basically what the efficiency ratio is, it's your ratio of expenses versus income. And what it means is that 49% of the income is expenses. So what that means is 51% of the income goes back to the bottom line, which is quite excellent. We find that many companies are at a 60, 55, or even 70% because their expenses are extremely high. We always speak about this. We always speak about ensuring that we are running an efficient business. We always speak about the fact that we aren't fancy. When we do have events, you'll notice that it is as cost effective as possible. We have our marketing team that is very diligent in how they spend, and we all put effort into ensuring that once the company is spending, it's value for money and it makes sense. So it's something that we pride ourselves with. It is excellent that it's at 49%, and we intend to keep it that way or reduce it. So I hope that explains it.
It certainly does. Thank you so much for expounding in that way. So let's go to the questions in the chat. The first question is, are you concerned at the rate at which you need to be raising external capital to unlend? Will you ever have enough capital?
I'm not concerned. And the reason is, let's take it, for example, as a different type of business. If you sell patties, for example, you will always need patties to sell. So you're always going to be in the market looking for patties, looking for the products to make the patties, and looking for it at the lowest cost. Because we are a lending company, we sell money. So we're always going to be in the market looking for money to sell, and looking for money at the lowest possible cost to sell. So basically that's it. Cash is our inventory, and we will always be stocking up on our inventory once there is demand to sell that inventory. And that's just basically it. And, to add some context to it, you look at other financial institutions, you have the large banks, you have other microcredit. They're always in the market raising funds, even the deposit taking ones that actually have funds coming in, because there is demand and they need it at the lowest cost to sell.
That's correct.
I love that explanation. Thank you. Thank you, Trev, as always. The next question, does Dollar reduce or increase its rates based on the BOJ's interest rates?
I can take that one. So not. I believe once we price our products at the beginning of most year, it really accounts for any fluctuation in the interest rate. But I believe more than the BOJ rate, we look at the rate at which we are able to get the capital to unlend. So of course those will have impact. Sometimes the bonds that we have may have variable components which will fluctuate based on the BOJ average rates. But ultimately the rates that we tend to offer are constant and really factor in both increases and decreases in the BOJ rate.
Thank you for that, Kenroy. What seasonalities affect Dolla's business, if any? And no, you would have shared that Q4 tends to be your best quarter. I can guess why, but I'd like the team to respond to this question.
Definitely. So as you said, Renee, the Q4 is of course the quarter where businesses see a lot of increase in their economic activities. And of course, we are a company that focuses a lot on loans to entrepreneurs and businesses. So with that increase from those small businesses, you can see how that automatically reflects in that being our best period in terms of lending. So that's pretty much one of the main period of the year that we see an uptick in business. However, from Q1 to Q3, there's still a consistent flow of businesses, and then we just look where the opportunities are, make the adjustments to our products, or just be innovative and see how much we can get out of a market.
All right, thank you. Why the move to private credit for Ultra? David, on you. Is this in preparation to diversify the portfolio before a possible listing?
So the move to private credit was, as much as it was a strategic move, it was really mainly to maintain our transparency. I mean, we've always been very honest with you guys and the public as to, you know, what collateral we hold. We don't have any luxury items as collateral. So obviously we needed to be very honest with ourselves and honest to the public that there was a need to shift out of this narrative of luxury lending. Obviously we still have the capability to do it, but our aim and where we want to situate ourselves in the market is in the private credit space. We want to help businesses grow. We want to help people do very, very meaningful things. And yes, you can do meaningful things using your luxury assets. And of course, we're still here for that. But we wanted to align ourselves in that private credit space. And ideally, that's where we've always wanted to be. Is it because of a possible listing? No. It was just because that's where we've always wanted to be, and we need to align ourselves in that manner. And I know the listing conversation will definitely come up as we continue on this call. And you know, our answer will definitely be the same, but I guess we can wait for it to come and we can address it there.
Thank you. Thank you, David. And by the way, let us just take a moment to say happy birthday to David, right?
Thank you, guys. Thank you.
Happy birthday.
Thank
Have
you.
a great one.
Yeah, thank
All
you.
right. So our next question, what conditions would need to be in place for Ultra to grow 4x in the next 2 years?
I think that we have the strategic plans to do so. Again, as Praveen mentioned, our business is selling cash. And once the cash is available to us, and we continue on the path that we are on now, I don't see why we can't achieve that. So once, as I said, once we have funds available to us and we can get these funds at good enough rates to therefore on lend to our clientele at rates that can work for them, I don't see why we can't grow 4x within the next couple of years. It's definitely possible.
Fantastic. David is asking, what is Ultra's loan portfolio size and the collateral size as well? I think, well, we would have done that in the slides,
Yeah,
but
I guess I can just for David's purposes. We're at 1.5 million now, and you know we collect collateral 2 times the loan, so we're sitting at just under 3 billion now.
All right. Next question. Also from David, is Ultra waiting on the government to adjust the 750 million threshold to list Ultra? Also, would Dolla do an equity raise if that threshold was to increase as well?
So I'll take the Ultra side, and I guess my Dolla guys can take the Dolla side. Yeah, I mean, definitely there's no point in us rushing to the market until the 750 is cleared. I mean, it would make no sense for us to rush it. So in our assessment of whether we do list or not, the 750 plays a massive role in that. So we are.
David, you're on mute.
Oh, sorry. Wow. So yeah, sorry, my bad. So yeah, so the 750 plays a massive role in our decision making to whether we list or not. It would absolutely make no sense for us to rush to market at the 500 cap. It would be silly of us. So we are assessing it, the pros and the cons of us listing, obviously, and obviously waiting on that 750 to be cleared before we make any moves ahead. But you know, it's obviously one of the most important things, or one of the most important players in our decision making. And I guess the Dolla guys can take whether Dolla will upstate.
So I think for the equity raise, of course, that's something that is being discussed because, as I mentioned, we are looking for effective ways to raise capital, and that is one of them, as opposed to bonds and all the other, ways to raise money on the capital market. So it's something that we're looking at. We're analyzing it, making sure that it makes sense before we are able to make a decision, get it approved and execute. So as usual, we're a publicly listed company, so if we're making a move like that, you'll be the first to know.
Thank you both for that. And at the recent JC conference, it was announced that is in the works, and in a few weeks, as it was announced as a few weeks, we'd be expecting that it should be in place. That 750 million threshold increase should be official. So we're waiting to see what actually happens in that space. Simon is asking, well, statement first, CEO said the portfolio grew mostly in Q4. What drove that, and what are the earnings expectations going forward on top of that portfolio?
All right, so I'll take that one, Simon. So as Traveen would have alluded earlier, we did close our bond in the latter part of 2024, I believe about October. We started receiving most of the drawdown. So those funds would have fueled the growth in the loan portfolio. Of course, when you plan for those disbursements, the profit you'll see an uptick in profit, but you won't see a material impact. So we are anticipating that we will see the full results of all of those disbursements during Q1 and Q2 of this year. But I can say that in Q4 we did I think we hit record disbursement numbers, about maybe a 57% over best quarter, because we actually received those funds and we found innovative ways to prudently unlend those funds. So you'll see the benefits, and of course, as Traveen also said earlier, it's a business that our inventory is cash, and cash is what we sell. So we will continue to push to collect as much as we can from those monies that we have lent, and we will continue to push to do as much to raise funds to ensure that we can continue to experience those growth that we saw in the latter part of 2024.
Thanks for that, Kenroy. We'll move right into the next question. This is from Michael. Any update on the Guyana collection, and is the timeline still on target?
So the Guyana, I'll go and allow Traveen to pop in just in case. But the Guyana wind down is going as expected. I can say that we have officially closed the location. That was about 2 weeks ago. We officially closed the location. However, the wind up process will take a few months, which means that during this time we're still pushing to collect as much as we can on the remaining portfolio. We had set a target in 2024 as to the sum that we need to collect on a monthly basis, and for the most part we were able to hit those numbers. We'd have seen some impact on the financials based on the winding down of Guyana, but for the most part it is going as projected, and the portfolio has dwindled to maybe about $32 million, and we're still in pursuit of those funds to collect as much as we can until the final date for the wind down. But for now we have ceased operation totally. The country manager will be back in Jamaica in a few weeks, take on a new role, and we'll continue to monitor that for the next 2 quarters until the process is entirely completed.
I love that update. Thank you, Kenroy. And we can always depend on our community to ask the pertinent questions, right? So the next question: with the pressures on the financial sector, why hasn't Dolla taken advantage of an acquisition to realize inorganic growth?
Okay, so that one, of course, we're acutely aware of what's happening in the industry, and I just want to say that at Dolla, we are not immune from certain shocks that happen in the financial sector. Of course, that's a space that we're in, But the important thing is that we have a different strategy, or we have strategies in place that will allow us to remain viable. Again, I said it earlier that in times of depression like this, or where there are concerns, there are always areas where we can look at opportunities and try as best as possible to leverage those opportunities. Acquisition on its own, it's a good thing. It sounds good, and it's good to announce that we're acquiring company A, company B, that augurs well for the stock and for the business itself. However, this is something that we have to approach very prudently. As you can see, our business and how we carry out lending in the microfinance space is different from how a lot of other players do so. And as such, this is something that we continue to assess. We will not rush into just acquiring a company for the sake of acquiring a company, which diverts attention to another company's problem. But at the same time, there are opportunities that I'm sure exist, and where there are opportunities, we will continue to just explore those. If it means looking at a loan portfolio just to see if it aligns with what we would want to take on, then that is something that we will surely do. I will not say if we're doing it, but that is something that we have been monitoring and just looking for those opportunities to see how we can continue to grow the business.
Okay. Thank you. Next question, please. Is the rise in non-performing loans concerning? Someone had asked what NPLs mean. That's what it means, non-performing loans. And I think having watched the call, you would have heard the explanations from both Kenroy and Trevine. So I hope that answers that particular question. But please go ahead. Is the rise in NPLs concerning for you?
At this point, it is not a concern for the company. I know when we look back at the statistics, probably in 2022, when we listed with a portfolio of about 700 million, our NPL was somewhere to the tune of about 7%, and we'd have seen where it has increased maybe 9 this year. I believe at 9.9% is perhaps one of the highest year-end NPL that we have. There are a few factors that are at play, and again, the most important thing is that we have strategies in place to deal with this. We anticipate that there will be fluctuations, and the 9.9% is representative of the group, right? So just take, for example, Ultra deals with high net worth, and we might have a loan of a significant balance. Let's say a $50 or $100 million loan at Ultra. That loan at Ultra would be 100% secured, and we have adequate collateral to where we can recover in the event of default. If a loan like that goes in a non-performing state, which is meaning that the customer has not honored their monthly payment for maybe about 3 months, what you will find is that will have a material impact on the group number. But at the same time, we may be in the process of liquidating that collateral, which once liquidated, those numbers will be coming down. So we continue to monitor that, and it also plays a part in our strategy going forward, where, for example, if we have a loan that is too, the exposure is too much, if that loan goes into a 90-day bucket, what we will do is what we look at, for example, is to say we will limit or put a cap on the loan amount per customer and those kind of things. So right now it's not a concern, and it's because of the 9.9% of the loans that are in a non-performing state, we probably have adequate collateral in place for about 8% of that, and we continue to pursue liquidation or other methods to get the accounts back in a performing state.
Simon is asking, so kudos to the team on having the strategies in place and continuing to use the process to keep that under control and being able to reassure the shareholders about the NPLs. Simon is asking, Mayberry seems to now have a controlling stake across various companies. What are the strategic intentions there? And any word on Michaela, if that's how it's spelled?
Well, I believe Mayberry would be the one to ask that question. Yeah, that information is public. It's public knowledge that they are a major shareholders. But I mean, the phrasing of the question is really one that maybe would need to answer, and not Dolla.
Got you. David asks, has Dolla considered purchasing loans from some of the other microcredit players in the space?
Right. I believe I would have captured that, David, in my prior answer regarding what's happening in the microfinance space.
Right. The question about the acquisitions. So I believe this should be for Traveen. Does the relatively small dividend of $30 million reflect the company's ambitious growth plans and need to hold more cash?
So that's somewhat correct, David. So yes, it's a reduced dividend. It's an increase over the last dividend that was paid, but it's not a 50% dividend payment or declaration. And that's simply because, yes, we didn't make the profits that we wanted to for 2024. And two, the prudency on the cash. We know that in Q1, we won't be executing on a fundraise for Q1, and we will need to retain the cash to on-lend to ensure that we're able to make those profits for Q1. So it's a mix of both. That's a good question.
And thanks for your answer. Philip is asking, would Dolla consider introducing an unsecured loan business line, whether organically or via acquisition?
So again, you can see that one of our major strategies is really focusing on secured loans. The portfolio that we have right now is 86% secured, and again, that is what really plays a key role in us maintaining a really low NPL and I just not NPL, ECL. And I just want to emphasize that a 2.6% ECL in this industry is unheard of, right? But what you need, what we will understand and appreciate is that an increase in ECL because we take on too many unsecured loans will mean a decrease in the bottom line, right? It will automatically lead to a decrease in the bottom line. So while we do unsecured loans, I guess acquiring a portfolio that is fully unsecured will all depend on the quality of that portfolio, whether they have robust things in place like salary deduction and again the price at which that portfolio will come, because price is also a very important thing. You don't want to overpay. It's better to really get a good portfolio at a good value that at the end of the day can return maximum value for our shareholders. So the last thing that we want to do is to just go in an acquisition mode, because there are companies struggling, and there's a reason why these companies might be struggling, because their portfolio is fully unsecured. So that's we continue to do unsecured loans. I personally, we always have to weigh when we have $1 billion, when we have $500 million to lend, whether it's better to lend it organically, where we have control over how we lend it, who we lend it to, or we acquire a portfolio that we might not be able to recover on those funds at the end of the day.
Mm-hmm. Understood. Would Dolla consider AI lending tools or platforms?
So this is something that we have been looking at. I believe Kenroy mentioned in probably a previous earnings call that we're kind of focusing now on operation efficiencies internally, just to ensure that once we want to, go outside and do AI and an app and all of that, then when we do that, it integrates properly, because technology investment is you have to be very strategic with it. We see many big companies that have the massive resources fall over when they're doing technology enhancement. So it's something that we're very strategic about how we do it. So we start fixing internally, being efficient internally with the system. So once we start to interface externally with the customers, then it's seamless. And another thing too, when it comes to AI, it's great. It's absolutely great, but AI has its challenges as well. In this business, it is not just about, the computer spitting out something or telling you that someone can get a loan. It's more looking at their character. It's more looking at, what they have been doing for the past couple of years. It's looking at things that you don't see on paper. And that is where we win, especially when it comes on to the larger loans, the ultra loans. You have many persons who have loans out there, that aren't reported on paper. But we know that because we ask around, and we or directors are familiar, or staff members are familiar. So it's more of the interpersonal and the soft skills that makes us win. And AI is not very good with the soft skills. So it will take us some time to get there, but once we get there, we'll make sure that it's working for the business.
Sounds progressive. So thanks. Thanks for that, Trevine. And I do recall our previous earnings call where it was mentioned. So the update is great. David is asking, was most of the net 734 million mainly from the dollar side or the ultra side? And where are most of Dolla's loans? Are they in transport, agriculture, etc.? So, yes, Kenroy, you can take that one.
All right, so I'll allow Trevine to take the expense side, but just to confirm, I think I had this in my presentation, the composition of the loan portfolio by sector. So the bulk of the loans, of course, we have a very diversified portfolio, but the haulage, trucking, and transportation industry and the real estate and construction represents a significant, maybe a little bit over 50% of the loan portfolio, while manufacturing, for example, retail, the business outsourcing sector, and a few others make up the remaining 50%.
I have a question from David, just so we can ensure that we're answering that question properly. The net 735 is from where exactly? What are we talking about? Expenses?
All right.
I guess we can come back to it.
Yeah. Yeah, we'll allow David to respond to that. So we'll jump to another question until we hear back from him on that. Simon says, strategic update, Ultra. Last year, the target was by year end, and that didn't happen. What is the new target? Any indicative guidance from the government on the new junior market limits?
So we didn't meet target last year. I mean, obviously we set ourselves very aggressive targets. And so for this year, our target is to get to about 2.4 to 2.5 billion. So our aim is to lend somewhere in the range of about 900 million to $1 billion this year. So that's our target, and we're going to definitely attack it as aggressively as possible. And then obviously, you know, it's all capital dependent, but you know, we're definitely going to attack it very hard. Any indicative guidance from the government on the new junior market limit? I mean, we spoke about this earlier, and we know that, you know, there's a very good chance that will be passed and gazetted, you know, very soon. And obviously that then continues to play into our decision-making process, obviously in management level, board level, and with, you know, our potential brokers of a deal, etc. So, you know, we sit tight, and you guys will be the first to know.
Thank you. So Trevine, back to the 734 million question. David says it's a consolidated loan book relative to cash flow.
Okay, I think I'm gonna need a little bit more clarity on that one. So, David, you might have to call me.
All right, so we press on. Philip asks, are there existing synergies with any of SVL's microloan businesses?
Not at this time, Philip. And if there are any discussions in play about that, then obviously we'll update you as soon as any of those take place.
All right. Simon is asking if there are any additional debt raises being targeted in 2025. And I believe you said
I would say yes.
Yeah. Yeah. All right. For Kenroy, is a branch growth strategy a tool needed to verify that customers are real? My questions come in the context of more lenders going digital with their loan applications.
Okay, I think Trevine alluded to this earlier, and I made mention that one of the difference between Dolla and a lot of the other microfinance lenders are that they focus a lot on other lenders focus a lot on personal consumer loans, which of course those loans tend to be very generic and easy to just log on, go on an app and apply for a loan. Whereas Dolla, our majority of our customers, 87% to be exact, are business customers. These are customers who have a business location somewhere that requires that our loans officers or our advisors are actually on spot at their location, learning more about the business, having a greater appreciation for what they do, how we can help them grow, and whether they can, in fact, be in a place to comfortably repay a loan that we lend to them. So while I know that AI, for example, will be a very useful tool for from a customer interface, the reality is that it doesn't what we're looking for, that interpersonal relationship with the customer, getting to know the customer, understanding their business, what they do. AI will not help us at this point in time, and that is one of the reasons why for 2025 we're not necessarily looking to expand further in terms of a branch network, because we have 11 branches which covers all 14 parishes, but it's very important to us that we're able to actually go into the businesses, see what they do, and have a great appreciation. And that's how we are able to actually design innovative products that we can tailor and to the specific needs that they have once we go in.
Okay, David is asking again, Dolla's Q4 expenses grew 27%, while the full year rose 32%. Was most of this rise in expenses due to staffing costs and marketing expenses?
So David, staff cost is correct. As you may have seen in our audited financials, where you are able to see the summary of the breakdown of expenses, staff costs are one of the largest items on our expense line. And we did see a 67% increase in staff costs year over year. A 65 million increase in staff costs year over year, which is just about 30%. In the presentation, I did mention that we had a benchmarking exercise that took place, I believe, last year or the year before, which saw staff coming up in terms of their salaries, just to ensure that they're being compensated based on industry standards, and also for the level of work that they are doing. We can look at it this way: the company has grown 3 times its size, and we really have not increased staff 3 times its size. So what that means is that we have staff who are taking on more tasks, and we ensure that they're compensated as such. We didn't see an increase though in marketing. Tashoni has been very diligent with ensuring that those costs are very in line. We can pride her on that. But we saw increases in legal and professional fees due to collections costs. All these bond raises and all of that, they do add up in terms of legal and professional fees, etc. We also saw increases in audit fees, which is something that is very widespread across the globe. And other smaller fees here and there that have to do with disbursement of loans and stuff like that. I hope that answers your question.
Very thorough, Trevine. And next question from David: do you expect to add more specialized loan categories going forward or other partnerships?
Right, so those are things that we continue to explore, David. We right now we have a suite of products that it kind of captures a lot of the almost all the needs of the customer. So when we do come up with a partnership, most times it falls under one of our existing products, but we will continue to explore those partnership opportunities where we see it add value for the business, especially when it comes to helping small businesses grow, and we will continue to leverage those opportunities as they go along.
All right, so we will close our Q&A segment with the clarification from David. One more attempt about that 734 million question. He says when he compares Q4 versus Q3 cash flow for loans receivable, he got 735 million.
Oh, okay. We're on the same page now. So that movement is definitely because of the loans that were unlent year over year. So what we lent in Q3 in 2023 versus what we lent in 2024. We have been mentioning throughout the call that we would have lent, I believe, 25% more in 2024 than we lent in 2023. And we did mention that especially after the fundraising Q4 of 2024, we lent out $1 billion. So that is what would have led to the movement in the cash flow for the loans receivable, because once we are lending more than we are receiving, which is what the business is, and that's how we grow, then you will see that movement. I hope that answers your question now.
All right. Thank you so much, team. Thank you, Kenroy, Trevine, birthday boy David. We do appreciate your time. We appreciate the effort that always goes into the dollar presentations, and the fact that you take the time to meet with your shareholders and speak with your shareholders in this way. So I also want to say thank you to the audience for being here, for asking the questions and being so engaged. We really do appreciate you as well. So in closing, I will ask that you continue to follow this channel. If you have not yet done so, please subscribe so that you can be in tune with all the content that is coming out here. You will see more of these earnings calls right here on this channel. So be sure to subscribe to it and turn on your notifications so you'll know when we are live. Thank you again to the Dolla team. Thank you, David from Ultra. And thank you to our audience. Have a great rest of the day.
Thanks, everyone.
Thanks, guys.
Thanks, everyone.